Hi guys, V-Tree Trong back with another video. I'm your trusted mortgage advisor, and today we're going to try to tackle that age-old question: should I take a 5-year fixed or a 5-year variable with my mortgage? And as you can see from the title of the video, I've changed my tune. I used to always recommend variable, but today I'm recommending everyone take the 5-year fixed. And here's why. So first thing we need to do is we need to look and examine why I initially recommended a variable rate for everybody in the first place, right? And the primary reason, and the most sensible one, is just lower cancellation penalties, right? Life happens to everybody, right? And the average mortgage these days lasts 38 months. And you may have signed for 5 years, but three years and a bit into it, the average Canadian cancels their mortgage. And that could be for a number of reasons, right? It could be you're upgrading your house. Maybe you have to relocate to another place, location for your job. Maybe it's a marital breakdown, unfortunately, right? Maybe your business is not doing too well with various economic circumstances going on. Maybe it could just be you've got too much debt because you just did a huge renovation project or something like that, right? Life happens to us all, and the average mortgage is 38 months. Therefore, we want to have a 3-month interest penalty, and that's what a variable rate mortgage is. It's always going to be a 3-month interest penalty, the lowest rate. Right? It's not going to be an IRD, which is an interest rate differential, right? IRD, interest rate differential. And that's where you hear the horror stories online of, $20,000 penalties, $30,000 penalties, that sort of thing. That does not happen with a variable rate mortgage. And that's why I picked that, because even though my clients don't enter into a mortgage, a 5-year mortgage, thinking that they're going to break it in 3.5 years, life happens, right, guys? So we can't really plan for that. And that's why, as your trusted advisor, I try to pre-plan a little bit of that for you. Okay, the second reason is rate difference, right? So back in the day, not today, but back in the day, the rate difference was at least 0.75% of a percent, so 0.75% more advantageous to get a variable rate mortgage than a fixed, right? Fixed always costs more, but it was guaranteed safe, right? Is it really though? So I'm going to illustrate a little point here with this next chart. So this is the chart of the last 10 years of what the Canadian bank prime mortgage rates have done. Okay, so this isn't Bank of Canada prime. This is what all the major lenders set their prime lending rate at. Okay, so now this is kind of cool because I actually had the privilege of renewing my mortgage back in 2015. During that time, I had the choice of a 2.79% 5-year fixed or a 1.99% variable rate mortgage. Okay, so both of those rates at the time, really, really attractive. And so you can see right there, prime was at 2.70 in 2015. So I essentially had a prime minus 0.71, right? And my difference with my fix was 0.8%, right? So right in line with what the numbers I've been talking about. So I took, of course, taking my own advice back then, I took the variable, I took 1.99. And then, 2 years later in 2017, now looking back, like kind of, when our economy went all the way up there and we had a lot of success in the last 3 years, this is when the rates started going up and the government started raising rates quite a bit, right? I know it must have seemed like rates went up 5%, when in reality, the prime rate went up 1.25%. In that really that boom time for us all. So what did my mortgage look like over that time? Well, in 2017 they raised rates a little bit. So, oops, here we go. So my mortgage in 2017, 2 years after I took it, so I won for 2 years, and it went up to 2.24. So I'm still winning versus the fixed I could have had, right? A few months later in September, it's 2.49, still winning. Next year, January 2018, 2.74. I'm still winning just barely, but I'm still ahead of where I could have been. And then after that in July and beyond, so all of 2019, so starting July 2018, all of 2019, I lost. So that's about a year and a half that I didn't win, right? I picked the rate I could have gotten, 2.79, right? I could have gotten that, but instead I'm paying 3.24. Okay, so I lost by 0.5% during that time. Remember though, for the time previous, I won. And then the pandemic hit, and the rates then started to come back down, started winning again, right? So all of that to say, over the last 5 years, I won for about 3.5 years. I lost for 1.5 years. So overall, I came out ahead on my mortgage. And that's why a lot of brokers have always traditionally recommended a 5-year variable, because we know cycles like this are going to happen. You know, obviously, we couldn't predict what the causes were, but you know, stuff happens all the time, and this is kind of the cycle. But now things have changed. Things have changed quite a bit, and as you know, I've changed my tune. So what's changed? Well, first of all, super low rates, right? So if you were to buy a house today under $1 million, so a townhouse, condo in Metro Vancouver, house elsewhere, you would have your choice right now between a 5-year fix of 1.89 or a 1.85% variable rate mortgage. At that difference, take the fixed all day long. There's no benefit in risking that 0.04%, right? Makes sense. If your house was over $1 million, or if you were refinancing to consolidate debt onto your mortgage, you have a choice between 2.29% fixed or a 2.05% variable. So about a 1/4 point difference. So that's a 1/4 point. That's not a lot. That's pretty much one rate hike, and then you're even, right? Anything above that, you've lost. So because the rates are so low right there, there's just no financial incentive to go with a variable rate. And that's the reason number one why now the rates are so low. Take the fixed all day long. And the second thing is, we talked about this earlier, was with the penalties, right? So now the rates are low, there's really good, and you know, and in the future rates are going to go up. I don't know that they're going to always, I should say, I don't know that rates aren't going lower. Like if the government starts going to negative interest rates, like they're starting to pay people to take money, all bets are off, right? But that would mean our economy, like something's really wrong with our economy, and we got some big problems. So I don't see that happening at all. What I do see is, I do see us, you know, in a sustained period of low rates right now. Like I think this is kind of a steady state for the next little while. In about 2 years, I think rates are going to go up. Like the economy is going to recover. We're going to start seeing another upward tick in about 2 years. You know, my crystal ball is a little murky, but that's what I'm thinking. So what I'm really saying is, now we're at the bottom. This is the bottom. Like we're really close to the bottom. So rates are only going to go up. That means the interest rate differential penalty will not apply. So this is how IRD works. So if you, for instance, you know, 3 or 4 years ago, you took a 3.5% mortgage, and today rates have dropped to 2.29. Let's call it 2.5% for easy math. That's a 1% lower rate today than when you took your mortgage 3 years ago, let's say. So if you were to cancel today because something forced you to sell, the bank would say, whoa, right? You owe us a 1% higher rate because we know you're trying to remortgage to a 2.5% from a 3.5, right? So we're losing 1%. Therefore, interest rate differential, we're going to charge you for all of that interest we're missing out on, right? And that can become a really big number, and that's IRD. But the reverse, when rates go up, right? So now you're at 2.5%, and 3 years later, now it's 3.5%. So that 1% difference, the bank would gladly let you cancel your mortgage for cheap, so a 3-month interest penalty, because they can take that mortgage they were selling to you at 2.5, take that money and sell it to someone else today or that time at 3.5%, right? So now they're making an extra 1%. So IRD will not apply in a rising rate environment, such as what we're going to experience once we come out of this pandemic. So those are the two reasons why I would recommend that right now, for the next little while, in August 2020, and you know, maybe a couple months beyond this, we all take the fixed rate mortgage, right? Get the 5-year fixed rate mortgage, lock it in. There's really no downside. There really isn't. Right? And like I said, unless we start going negative interest rates, which I don't think is going to happen. Okay, so those are the reasons. There is, though, one more thing. No, all we've been talking about right now is just the entire thing into a 5-year fix, or the entire thing into a variable. If you can, guys, get a HELOC, right? A home equity line of credit. Goes by other names like an RBC, a Home Line, or a Ready Line, or a Home Power Play, or a Manulife One. Any of those types of products, because that's going to give you a line of credit mortgage, and then inside that you can fix you can take a 5-year fix inside of that HELOC to give you the best of both worlds, right? You can have the flexibility of the line of credit, but you can also have a giant part of your mortgage taking advantage of the super, super low rate for the next 5 years, right? And if catastrophe happened and you need all of that money and you need to cancel, it's probably just going to be a 3-month interest penalty and not an interest rate differential penalty. Okay, so that's a different video. I've got a whole nother talk on that. So hit the subscribe button and you'll be notified once that happens, and we'll catch you next time.